Hi, my name's Robert Smolin. Today's topic is leases. This is a big chapter and it's difficult material. And I don't recommend that you try to watch and absorb everything in one sitting. If that's what you got to do, that's what you got to do. But the better thing to do is to watch it in segments. So I've broken it up into 5 parts. The first part is somewhat introductory. And then we'll have 4 different lease scenarios. And I'll let you decide when you've hit the point that you're not absorbing more material, and then you can watch it over as many times as you need to. Please read the note at the bottom there. I assume you've read the chapter and you have some basic understanding of leases. Okay, this is not a good starting point since I'm not going to be lecturing, so to speak. I'm going to be going through examples. And I'll walk you through the calculations, but it will help if you've read the chapter and you know what I'm talking about. You're familiar with some of the terminology. Okay, so here we go. First, we have to decide what type of lease we're dealing with. And there are 2 basic types of leases. For the lessee, it's either a finance lease or an operating lease. And for the lessor, it's either a sales type lease with or without profit, selling profit, or an operating lease. Now, in order to determine the lease classification, there are 5 items or criteria that have to be evaluated. And this is very important. If any one of these 5 criteria are met, then for the lessee it is a financing lease, and for the lessor it is a sales type lease. In order for it to be an operating lease, it has to fail all 5 tests. Okay, transfer of ownership. If the lease transfers to the lessee at the end of the lease, then this is clearly a finance/sales type lease. If there's what's called a bargain purchase option, which means the price they would pay is significantly below what the fair value is estimated to be at the end of the lease, then we assume the lessee would take advantage of that opportunity. Then it's again a finance/sales type lease. If the life of the lease is 75% or more of the asset's estimated useful life, same thing. If the lease payments, the present value of lease payments is 90% or more of the fair value of the asset, then it passes the test. Or if the equipment is so specialized that when the lessor gets it back, there's really nothing they can do with it, then it's also, for all intents and purposes, a sale, which is what a finance/sales type lease is. It's a sale that's being financed in the form of a lease. We don't need to get into the legality of leases. That's for a different class. For an example, crayons. The equipment to make crayons is very, very specialized. There's no other use for this machinery. So if the lease ends and the lessor gets this machine back, unless they're lucky enough to have some other crayon maker want an old machine, then they're stuck with this piece of equipment. That's what we mean by specialized purpose. That won't be an issue in our examples, but it's something you need to be aware of. Okay, so we're going to look at our first example. This is a basic example. And let's present the information and we'll go through it. Okay, on January 1st, 2011, ABC Company, that would be the lessee, leases standard construction equipment from XYZ, the lessor. Notice I said standard construction equipment. That rules out the 5th criteria. It's not specialized. XYZ purchased the equipment for $125,000, which is the fair value of the equipment, and they expect the useful life to be 5 years. So we can see that this is going to be a finance/sales type lease. There is no residual value. We'll revisit residual value a little bit later. Ownership does not transfer at the end of the lease, and there is no bargain purchase option. Now, the implicit rate on the lease, what that means is that this is the rate that the lessor is applying to determine the value of the lease. That is known to the lessee. When the implicit rate is known to the lessee, we use the implicit rate. More often than not, the lessee is not going to know the implicit rate that the lessor is using, in which case we would use what's called the lessee's incremental borrowing rate, which is what the rate they get when they borrow from the bank. that would be 6%. But again, since ABC knows the implicit rate, we're going to be using 5%. The annual lease payments will be $27,497, and they'll be paid on the first day of the lease, and they'll be made on January 1st of each year of the lease. Since the lease payments are being made on the first day of the year, this would be an annuity due, and when we're calculating present value for the lease payments, we're going to use the annuity due tables, not the ordinary annuity tables. Very important that you understand the difference. Ordinary annuity table is for when the payment is made at the end of the term, such as a bond interest payment. Okay, so we're going to go through the 5 criteria, which we somewhat did already, but let's go through it again. There was no transfer of ownership. It fails that test. No bargain purchase option. It fails that test. The lease life is 5 years. The asset's estimated useful life is also 5 years. That's more than 75%. It's 100%. It passes that test. Therefore, it's a finance/sales type lease, since it only has to pass one of those 5 tests, any one of those 5. Lease payments, as we're going to see, they equal 100% of the fair value of the lease. Therefore, it passes that test. And this is not specialized equipment. It fails that test. Since it passed one or more of the criteria, it is a finance lease for the lessee, a sales type lease, in this case without selling profit, for the lessor. And so we'll see both types of sales type lease for the lessor, with and without selling profit. It's not a big deal. Okay. Payments are due at the beginning of the lease, so we use the annuity due tables as previously mentioned. Since this is a finance lease, the substance of the transaction is similar to a purchase by the lessee and a sale by the lessor, even though the lessor will receive the asset at the end of the lease life. So the lessee is going to record what's called a right of use asset and a lease liability on their balance sheet. The asset will be amortized, which is similar to depreciation, using the straight line method over the lease life, and will amortize the liability using the effective interest method. Now, we're going to see the effective method in amortizing bonds and amortizing bond investments, as well as leases. It's used in pension calculations, so this is a method you simply need to know. The lessor records a lease receivable, and they derecognize. That's a term that's popped up in the last several years. Derecognition simply means they're going to credit the equipment account to remove it from its balance sheet, similar to a sale. Okay? The receivable will be amortized using the effective interest method. So if we go to the present value annuity due table, which I do not have in this presentation, but you can easily look it up online or in your textbook. Again, make sure it's the annuity due table, not the ordinary annuity table. We will go N for the number of periods, that's 5 periods, in this case 5 years, and the interest rate is 5%, and we would see that the annuity due factor, present value annuity due factor, not future value, would be 4.54595. We multiply that times the annual lease payment, and that equals $125,000, which happens to be the fair value of the asset, and that's not a coincidence. If you look at the note at the bottom, how did the lessor determine the lease payment? They took the fair value of the asset, divided it by the present value annuity due factor, and that's how they got the lease payment. Okay? So let's take a look at the amortization table that both lessee and lessor will use. Now, we can see the fair value at the beginning of the lease is $125,000. There are my 5 payments at the beginning of each year. And notice, since we're making the payment on the first day of the year for year 1, no time has lapsed, so there's no interest calculation. So notice the interest expense for the lessee, or the interest revenue for the lessor, is 0. And that $27,497 payment will go entirely towards the reduction of the lease liability for the lessee, and it'll reduce the lease receivable for the lessor. And so 125 minus the $27,497 will leave an outstanding balance for the lease liability and lease receivable of $97,503. You should have your calculator in front of you, since you're going to need to run these calculations. Now, if you multiply $97,503 times the 5% interest rate used in this lease, you will calculate interest of $4,875. Since our payment is $27,497, you would subtract the $4,875 of interest from the payment, and that would reduce the balance of the lease liability or lease receivable by $22,622. $97,503 minus $22,622 leaves an outstanding balance of $74,881. So for the remainder of this lease, both lessee and lessor are going to go through a similar set of calculations. Let's just walk through one more, and then we'll look at the journal entries. $74,881 times 5% will generate interest of $37.44. So we have our payment of $27,497. We subtract $37.44, and that's going to reduce the lease liability or lease receivable by $23,753. leaving an outstanding balance of $51,128. I will let you review the amortization table and bring it down to zero at the end of the last year on your own time. Okay, but it's important that you understand how to create and understand the amortization table, since both parties will be using the same table for the journal entries. So now we're going to look at the journal entries. I'm going to recommend that you print this out, since it might be difficult to read on your computer, and you might want to have your amortization table in front of you when you're looking at the journal entries. I have to refer to my paper since it's in small type here, but for the lessee, on January 1st of 2011, the first day of the lease, we're going to record two journal entries. First, we're going to debit the right of use asset, ROU asset, for $125,000, and we're going to credit the lease liability for $125,000. And since we make payments on the first day of the year, we're also going to make our very first lease payment. So we're going to debit the lease liability for $27,497, and we're going to credit cash. We will see that the lessor will do the mirror image journal entry when we look at the journal entries for the lessor. It is now December 31st, 2011 of year one of the lease. We have to accrue interest at year end. We're assuming the fiscal year end is December 31st. So in year one, December 31st, we will have accrued $4,875 of interest expense. We're going to pay that the very next day, which is year two, January 1st of year two. So December 31st of year one, we're going to debit interest expense for $4,875, and we're going to credit interest payable for $4,875. That's an adjusting journal entry. We are also going to record amortization of the asset, and think of this as depreciation. We're going to debit depreciation expense for $25,000, and we're going to credit either accumulated depreciation, or you can credit the ROU asset, either way. Okay, it's now January 1st, 2012, the beginning of the second year of the lease, and the lessee is going to make their second lease payment of $27,497. So the journal entry will be right here, okay? And notice it'll be a debit to the lease liability for $22,622, debit interest payable for $4,875, and credit cash for $27,497. Remember, interest expense got closed out. It's a temporary account. I have a video on closing entries if you're rusty in that area. Okay, but interest payable is a liability. It doesn't go away until we pay that liability, which we're doing on January 1st of year two. Okay, so we debited lease liability, debit interest payable, credit cash for $27,497. At the end of year two, we do the same thing as we did at the end of year one. We're going to accrue interest expense, and if you look at the amortization table, debit interest expense $37.44, credit interest payable, $37.44, and we're going to depreciate or amortize the asset, and again, it's straight line, so same numbers. Debit depreciation expense, $25,000, credit accumulated depreciation or crediting the right of use asset for $25,000. Now, based on those first 2 years, you should be able to finish the journal entries for the remaining 3 years. And I'm going to let you look at the amortization table. You have the journal entries. It's good practice for you to build those journal entries and to finish the journal entries for the remainder of the lease. Okay? Now, the lessor, on January 1st of 2001, they're going to record a lease receivable for $125,000, and they're going to credit the equipment account. That's that derecognition we talked about for $125,000. And remember the lease payment, same day, first lease payment, they're going to debit cash for $27,497, and they're going to credit the lease receivable for $27,497. Okay? At the end of year 1, they have to accrue interest revenue. So they're going to debit interest receivable, since again, they're not going to receive it till the following day, which is the new time period. So they're going to debit interest receivable, $48.75, credit interest revenue, $48.75. You're going to want to compare the lessor journal entries to the lessee journal entries, and you'll see the relationship. They're the mirror images of each other. It's similar with notes receivable and notes payable. The beginning of year 2, January 1st of 2012, which is right around here. Okay. They're going to receive their second payment of $27,497, so they debit cash. They're going to debit interest receivable. Since they're receiving that receivable, they're going to credit it and remove it. And then they're going to credit the lease receivable for $22,622, which is the difference between the lease payment and the interest related to it. Okay? At the end of year 2, we have the same adjusting entry. We're going to debit interest receivable for $37.44, and we're going to credit interest revenue for $37.44. And you will see these numbers when you look at the amortization table. And again, I encourage you to probably print out the journal entries, since I know they're going to be kind of hard to see in your computer, and have your amortization table either printed out or on the screen, and work your way through this, and this will make you feel a lot more comfortable about this topic. Since it's possible your teacher could ask you to prepare lessee journal entries or lessor, or possibly even both. So you want to be familiar with both. Okay, so that was what I would call the basic lease, finance/sales type lease from both lessee and lessor's standpoint, without any unusual circumstances. Now, I do have to say, leases are complex, and there is a lot of different situations and variations, and we are not going to try to cover everything. I'm going to cover the most common topics, such as when there's residual value, or if there's a bargain purchase element or an option, and then we're going to talk about operating leases. For the more complex stuff, it's in your textbooks. Hopefully your teacher will provide guidance whether or not you need to know those additional areas. Okay, so now we're going to look at the exact same lease, but this is when there is a selling or a sales profit included. Think of it this way. The lessor purchased the equipment from the equipment manufacturer for $110,000, and they would either sell it or lease it based on the fair value of $125,000. The difference between the cost and the fair value of the asset, which is the $15,000, that is going to be the profit. Okay, look at the journal entry that the lessor is going to record on January 1st, 2011, day 1 of the lease. They're going to debit lease receivable for $125,000. That didn't change, but they're going to debit cost of goods sold for $110,000. Okay, then they're going to credit sales revenue, $125,000, and they're going to credit the equipment account for $110,000. This should look very similar to a sale, where instead of a lease receivable, we're debiting accounts receivable. Everything else would be identical. So this is not a difficult journal entry. Everything else, all the remaining journal entries, for both lessee and lessor stay the same. Notice the lessee is not affected when there's a sales profit. This is purely a single journal entry on day one of the lease for the lessor to recognize the difference between what they paid for the asset and what they're leasing it out for, the fair value. So not difficult. Okay, the next thing we're going to look at, and this is where you may want to pause and digest all this information, but if you're ready to go on, we're now going to take the same lease information, but we're going to factor in residual value. You should be familiar with residual value from your fixed assets or property, plant, and equipment discussion. Okay, remember, we buy an asset, we estimate salvage or residual value, and we estimate the useful life. That's all that's being done here. This is being done by the lessor. Okay, so let's go ahead and read the information. When there is a residual value for the asset, the lessor will commonly use this to lower the lease payments, making the lease more attractive to the lessee. Competition. Okay, if we can make the lease payments lower, that makes this lease more attractive to a lessee. The amortization tables for the lessee and the lessor are different. We'll have two different tables. We'll look at both because of this residual value. So first we're going to look at the lessee's amortization table, assuming a residual value of $10,000. Now the residual value, think about it, at the end of 5 years, end of the 5-year lease, we're going to turn in this equipment with an estimated value of $10,000. So notice what we did. We took the present value of that future receipt of a $10,000 piece of equipment, and we go to the present value of 1 table, where N is the number of periods, that's 5, the interest rate is 5%, and the present value of 1 is 0.78353. We multiply that times the residual value of $10,000 and the present value of the equipment at the end of this lease. Its residual value, the present value, is $7,835. And we subtract that amount from the fair value to determine the amount to recover from the lease payments, which is $117,165. Okay, now, present value annuity due. The lease payments are made at the beginning of the period. 5-year lease, interest rate 5%, same annuity due factor, 4.54595. We take the amount to recover from the lease payments of $117,165. We divide it by that factor of 4.54, and the new lease payment, notice it's lower. It's $25,773 instead of the $27,497 in the earlier example. Okay, so that makes it more attractive to the lessee. So let's take a look at the lessee's amortization table. Notice the lease balance begins at $117,165. My lease payments, $25,773. And everything else about this amortization table, the mechanics, are identical to what we saw earlier. So take a moment to reconstruct these numbers. You shouldn't have any difficulty coming up with these numbers. Remember, the very first payment is on the day 1 of the lease. So there's no interest that accrued. That entire $25,773 reduces the lease balance. So $117,165 minus $25,773 equals $91,000, and I think that's $392. Okay? The next payment a year later, that'll accrue interest. $91,392 times 5% will generate interest of $4,570. We subtract the interest from the payment of $25,773, and the lease liability will be reduced by $21,203, and $91,392 lease balance minus $21,203 leaves an end-of-year lease balance of $70,189. So again, take a few minutes to reconstruct these numbers, and then comparing this to the earlier example, I'm going to ask you to prepare the journal entries. Okay, we're now going to look at the lessor's amortization table, which again is different than the lessee's. Okay, again, our residual value is $10,000. And notice, the beginning balance for the lessor, is $125,000, since in addition to those 5 payments, they're going to receive an asset that is worth $10,000. Now, that asset, they might lease it out again in a short-term lease, they might sell it, they might use it. It has value to the lessor. So that's why this amortization table is different, because of the value of the residual asset. Okay, so we start with 125. Again, the first lease payment is on day 1 of the lease. There's no interest that accrues. So we subtract the entire $25,773 from the fair value of the lease of 125. 125 minus 25,773 gives you a balance of, looks like 99,227. And then the whole process begins again. 99,227, which is the lease balance after the first payment, times 5% interest. In year 1, they will earn $4,961 of interest revenue. They receive $25,773 minus the $4,961. The receivable would then go down by $20,812, leaving a year-end balance of $78,415, and so forth. And again, the mechanics of this process are identical. So I want you to finish constructing the amortization table. I want you to prepare the journal entries. You have the first example that I gave you as your guideline. Again, the journal entries are going to be identical. The numbers will be a little different. Now, at the very end of the lease, the lessee gives back the old equipment, which has a residual value of $10,000. And remember, the lessor de-recognized this equipment at the beginning of the lease. They're receiving the equipment now, so now they have to recognize that they have the equipment. Look at the journal entry that the lessor records on December 31st, 2015. They debit the equipment for $10,000, the residual value. They're going to credit the lease receivable for the remaining balance of $9,526. And in the last year, they recognize $476 of interest revenue. And again, there's a small rounding error in there. So if you want the journal entry to balance, put whatever the interest revenue would be, $474 in this case. Okay, so I want you to review these journal entries for both lessee and lessor. Hit pause, turn it off, and don't come back for the next one until you're comfortable with the basics for the amortization tables and journal entries for both lessee and lessor with the residual value. As we're going to see with the bargain purchase element, there's a lot of similarity here. And that's what we're going to look at next. Okay, so now that we've covered the lease with the residual value from both the lessee's and the lessor's standpoint, here are the journal entries for both lessee and lessor. I'm going to let you review these on your own before we talk about the next topic, which will be when the lease has a bargain purchase option, which allows the lessee to purchase the asset for an amount considerably less than what the residual value would be, making it certain that the lessee is going to take advantage of that. Okay, our next example is when the lease has a bargain purchase option. Here's the data. Notice it's the same fair value. And notice the bargain purchase option is the same amount that the residual was. Now, briefly, this contradicts what I said a moment ago. I'm doing this for simplicity's sake. In real life, if the bargain purchase option were for $10,000, that would mean the residual value was probably more than that. Remember, a bargain purchase option is a good deal for the lessee. They're going to take advantage of this. Okay? So having said that, for simplicity's sake, we're going to just simply use these numbers. And notice the calculations are identical. Fair value, we subtract the present value of the bargain purchase option, which is the exact same number we use for the residual value. And the amount to recover from the lease payments is $117,165. And we use the same present value annuity due factor, which is the 4.54 number, and we come up with the exact same set of calculations that we saw earlier. So there's a lot of similarity in these examples. So this amortization table is for both lessee and lessor, since the lessee is going to cut a check for $10,000 at the end of the lease to give to the lessor, and then they're going to keep the asset. Now, something important to note, the depreciation that the lessee will use will be based on the useful life of the asset, not the lease, since they're going to own the asset. So please make note of that. In this example, it's not a big issue, but in just something to remember, since if the lease is 5 years and the useful life is 6 years, you want to use 6 years. So if we look at this amortization table, it is identical, 100% the same as the amortization table for the lessor when we had a residual value. So you can review the calculations on your own, and I will provide the journal entries for this for you to review on your own as well. I really don't have to spend that much time talking about it, since you're going to see everything is by and large the same, and you'll recognize the numbers in the journal entries. Okay? Okay, so here are the journal entries for the lease with a bargain purchase option for the lessee. So I want you to look at these on your own, take your time, compare them to the residual value example and the first example, so you kind of understand where the different numbers are coming from. And then here are the journal entries for the lessor, and same thing. Take your time, review these, get comfortable with them before we go on. Okay, so now we're going to look at operating leases. An operating lease has to fail all 5 of the criteria in order for the classification to be operating. So we're going to take the same asset with the same fair value of $125,000. However, the lease is going to be for 3 years, and since the lessor is going to get this asset back with another couple of years of use, we're going to assume the residual value is $50,000. Okay? So it's going to fail all 5 tests. There's no transfer of ownership. There's no bargain purchase option. The lease is 3 years, and if you take 3 divided by the 5-year useful life, that's 60%. That's lower than the 75% cutoff test. And we're going to calculate the present value of the lease payments, and we're going to see that it's less than 90% of the fair value of the asset. So it's going to fail that test as well. And then last, since this is standard equipment, it's not specialized, it fails that test as well. All right, so looking at the data here, we see that if the present value of lease payments based on 3 years and a 5% interest rate, for the residual value, that's going to be 0.86384. Okay, we go to the present value of 1 for the residual value, since it's a one-time calculation. What is the present value of the residual? Well, if we bring it back 5 years, 50,000 times 0.86384 gives us 43,192. We're going to subtract that amount from the fair value, and then the amount to be recovered by lease payments is going to be $81,808. How do we get that? We took $125,000 fair value minus the present value of the residual, which is $43,192. That gives us $81,808. If we want to determine what the lease payment is, we're going to take that $81,808 and we're going to divide that by the present value annuity due factor. So we go to the present value annuity due table, 3 years, or n equals 3, I, or interest rate equals 5%. That factor is 2.85941. So we divide 81,808 divided by 2.85, and our lease payment is going to be $28,610. Let's look at the amortization table for the lessee. The lessor is not going to use an amortization table. So for the lessee, we start with $81,808. Now there's going to be 3 payments. They're made at the beginning of the year. So on day 1 of the lease, we make our first payment of $28,610. And since it's on day 1, no interest has accrued. So we're going to subtract the entire payment of $28,610 from the $81,808 balance. And that's going to leave an unpaid balance of $53,198. Now, with your calculators in front of you, we multiply $53,198 times 5%, and in the end of year 1, we have to accrue interest of $2,660. Okay? And we'll look at the journal entries in a moment. But these amortization tables, you should be comfortable with these by now, how they work. So our second payment of $28,610, we would subtract the $2,660 of accrued interest, which we made at the end of year 1, and that would result in a lease liability reduction of $25,950. So please take a moment to get comfortable with the math here on this table, and you should be able to understand how this amortization table works. Okay? So hit pause until you're ready to come back, but I'm going to assume that you're comfortable with the amortization table and how it works, and we're going to move on. So we're going to look at the journal entries for the lessee first, and then we'll look at the journal entries for the lessor. Okay. The journal entry to make the lease payment is going to be the same as we've always seen. On day 1, we would debit lease liability, credit the cash account for the $28,610. Remember, we will create an asset, an ROU asset, right of use asset, for the amount of $81,808, and we're going to credit the lease liability. So I'm going to jump to the slides for a moment. Okay, so you can see them. Here's the first 2 journal entries on day 1 of the lease. There they are. Okay, and then at the end of year 1, we're going to accrue interest of $2,660. And again, we calculated that a moment ago. Go back to the amortization table and multiply the balance at the end of year 1 times the interest rate, and you should be able to reconstruct the $2660. So we debit interest expense, we credit interest payable. Now, the depreciation journal entry is unique. Okay, here it is. Debit depreciation expense, credit the ROU asset, or credit accumulated depreciation, that's fine. And remember, it might be called amortization. It's the same thing. It's how we get the number that's unique. I'm going to go back to the previous slide to talk about that. Notice it says, to amortize or depreciate the asset, we do not use straight line amortization. In an operating lease, since this is not considered the same as a purchase, we want the total lease payments to be on a straight line basis, and they're going to mirror the amount of lease payments that the lessor receives. So how do we accomplish that? This is how we do it. The depreciation calculation, it's not really even a calculation. We're going to look at the total dollar value of the lease payment, okay? And the interest is going to be one portion, the interest expense of $2660, and the depreciation is going to be the amount that when we add it to interest expense, it'll equal the amount of the lease payment. Now, let's take a look at the amortization table for a moment. Okay, we can see that the second line, on January 1st, 2012, we have interest of $2660, and a reduction of $25,950. There are the two amounts that we're going to use at the end of year one. These are adjusting journal entries. The interest expense, $2660, we already calculated, and the depreciation is simply the difference between the lease payment and the interest expense, which is $25,950. So there's no calculation. It's not straight line, it's not double declining balance or any other depreciation method. It's simply the amount that is, when you add it to the interest expense, it will equal the amount of the lease payment. Okay, now, that lease payment is also what the lessor is going to record as lease revenue. And so with an operating lease, which is more like a rental, the lease expense and the lease revenue from lessee and lessor should be the same amount. Okay, so kind of threw a lot at you right now, but the mechanics of this are relatively simple. Okay, and to kind of reconstruct, you see where we got the $81,808 balance. Okay, we subtracted the present value of the residual from the fair value to determine the value of the lease payments, $81,808. The first payment comes on day one. That entire amount reduces the lease balance to $53,198. We multiplied that times 5%, that's the interest rate we're using, to determine the interest expense. And then the depreciation will simply be the lease payment minus the interest expense for the year, $2660, and that'll give us the amount of depreciation. It's a little strange, but that's how we do it with an operating lease. Okay? And there it is in pretty much the same words that I said earlier. Okay? And so you can review the journal entries for the following year. Okay? In fact, I'll just show them to you right now. On January 1st, 2012, there's that second lease payment of $28,610. Now remember, we accrued interest at the end of year one, debit interest expense, credit interest payable. The interest expense got closed out. Interest payable is still on the balance sheet. Now that we're making that payment, we're going to debit interest payable. We're going to debit the lease liability by the difference between the lease payment and the interest expense, and then we credit cash for $28,610, which is the amount of the lease payment. In the following year, if you look at the amortization table, you'll see how we calculate interest expense of $1362. For the depreciation at the end of year two, we're going to take the lease payment minus interest expense of $1362, and that's going to give us depreciation of $27,248. Debit depreciation or amortization expense, credit ROU asset, or accumulated depreciation, either one. Okay? And then at the beginning of year three, we make our final lease payment, okay, of $28,610, and there's the journal entry. Okay? Now, this is important. For reporting purposes, the lessee only reports one line item on the income statement, and that's lease expense. How do they get that number? They add the interest expense plus the depreciation for each year, and they call that lease expense on the income statement. And that number, as I said earlier, will be the same dollar amount that the lessor records as lease revenue. So now we're going to look at the journal entries for the lessor. Now remember, the lessor does not have an amortization table. This asset is theirs. Okay? They did not de-recognize the asset. Okay? So on day one, January 1st, they debit cash for $28,610, and notice what they credit. They credit deferred revenue, deferred lease revenue. Think of it as unearned revenue, which you learned in your earlier accounting classes. Okay? They haven't earned it yet. At the end of year one, and these journal entries will be the same for all 3 years, by the way, notice what they do. The adjusting entry. Since they've now earned 1 year's worth of lease revenue, they're going to debit deferred revenue or unearned revenue, and they're going to credit lease revenue for $28,610. Very straightforward. All 3 years will have the same journal entry. And notice the depreciation. Remember, they own the asset, so they're going to use the useful life of the asset. Fair value is $125. Residual or salvage value is $50,000. So straight line depreciation, cost minus residual, divided by the useful life, and we get, is it $15,000 per year? Okay, and that's the journal entry right there. Years 2 and 3 will have the exact same journal entries. I'll show you, but they all stay the same. Okay, there's the journal entries for 2012 and the journal entries for 2013. Okay, so your job is to make sense of all this. And when it comes to difficult accounting topics, just remember, very few people remember everything the first time they read it or the first time they see it. You gotta see it 2 or 3 times. You gotta practice this stuff. So go back, review these, practice questions in your book, ask your teachers questions, and you should be able to get a grip on this stuff.